All right, because I don't see. Oh, it's under last week's thing. All right, whatever. Okay, welcome everybody. Today is the 21st, even if it says it's the 14th on the show description, but that's okay. We will figure it out someday. Someday I will go live and there will be no problems and everything will just be fine. And that day is not today. But all right, so it is the 21st. It is January. This is the Trillion Dollar Show, where the mission is to save $1 trillion. I want to save Americans $1 trillion in taxes. Now, yesterday there was a big event. There was this guy, he's got weird hair. He was sworn into office as president. And we're going to talk a little bit about what we can expect or what we hope to see over the next couple of months and how it's going to change things tax-wise. But regardless of what changes with the tax law, I still want to save Americans $1 trillion. That's the mission. How are we going to do that? We're scaling tax saving strategies through technology. Obviously, we're Tax Sherpa and we help our clients save tons of money. We don't save $1 trillion, and I don't think Tax Sherpa will ever be large enough to save $1 trillion directly. But what we can do is we can help people save on their own through tax strategy technology. And that's going to be in the form of tools, in the form of educational courses, all kinds of things that show people how to set up their lives from a tax perspective so that they can pay less. And then we can save $1 trillion at scale. Who am I? I'm Neal. I'm the founder of Tax Sherpa. I got into this whole tax game because I owed the IRS over $1.3 million. And I had to fix my problems. And in fixing my own problems, I started helping other people fix their problems. That's the 30-second version of how this all came to be. Yeah, over the last 15 years, I've worked on over 50,000 tax returns and have saved people millions and millions of dollars. So we're not quite to a trillion yet, but we're on our way. I founded Tax Sherpa really focus on helping our tribe save money. And there's a lot of tax people out there. I would say 80% of them, maybe 90%, are really just putting the numbers in the forms. And hopefully they do it in the right way. Serena and I were on a call earlier with a client that came to us from an acquisition that we did. And not the people we acquired from, but people prior to that had screwed this guy up and created all kinds of weird stuff on tax returns. And we're still, 3 years later, still fixing these issues. Hopefully those 80% fill out those forms at least in the correct way, but that is not always what happens. How can you start to money? I created a starter course. And when you're an explorer, you can get into the starter course and it takes you through the basics, the basic first couple steps of getting your tax world in shape. And we'll go into how you can access that later on. But for now, let's get to some questions. And I know the answer to every tax question in the world that you've ever asked, the answer is it depends.
It depends.
It depends on facts and circumstances. It depends on what's going on in your life. It depends on what is going on with the situation, and everything depends. It sounds like a trite answer, but it's really true. What is true for you is not necessarily going to be true for your neighbor, who might have the exact same event happen, but it could be a different character for them than it is for you. So it just depends. One of the things before we get into questions that Serena has, because I don't know what the questions are, I did want to talk a little bit about the inauguration, the new administration, and what we can expect going forward. Trump was sworn in yesterday, and Johnson, the Speaker of the House, has said he wants to get a tax reconciliation bill passed by April. So a reconciliation bill is the same maneuver that they used for the Tax Cut and Jobs Act back in 2017. And this allows for them to pass it on just simple majority. So they don't have to worry about filibusters and all these kinds of things. So if they have 50% of the House and 50% of the Senate, then they can get it done, assuming everybody falls in line. That is likely to happen. And there have been all kinds of talk about all kinds of different things about how these changes are going to be put into place. A couple things that are likely. Likely, number one, is keeping the majority of the elements of Tax Cut and Jobs Act from 2017 in place. And that's going to mean qualified business income deduction. That's going to mean no exemptions, larger standard deduction. That's going to mean, with the standard deduction, one of the things they're talking about changing is getting rid of the SALT cap. So if you live in a state where you pay a lot of local taxes, well, state income tax, property taxes, all that kind of stuff, under Tax Cut and Jobs Act, that had been limited to $10,000. and they're talking about removing that limit. So that could be interesting. Depreciation is going to be a big one. So under the original Tax Cut and Jobs Act, we got 100% bonus depreciation, meaning that if you bought an asset for your business that had a long life, let's say a piece of machinery, right? Normally, you would write that off over 5 years, and so you would take 20% of the cost in year one, 20% of the cost in year two, 20% of the cost in year three, and so on. Instead, they were able to take the full cost in year one. And that's really helpful because if you bought the thing, you're out the cash. So it makes sense to match that with the tax return and decreasing your income by that amount. The goal was to incentivize American companies to buy equipment and capital expenditures and all these kinds of things, which to a limited degree, I would say was successful. Um, but as since the Tax Cut and Jobs Act was passed on a 10-year timeline, and we're coming to the end of those 10 years, then the bonus depreciation got reduced year by year by 20%. So they have talked about retroactively reinstating that 100% bonus depreciation. And if that happens, that's actually a major change that could require, not require, but could allow for amending past tax returns and getting refunds from taxes that you already paid in previous years. So that could potentially be really helpful. And then there's all these other things that are not directly related to Tax Cut and Jobs Act. There's the thing about no tax on tips, no tax on Social Security income. And so that's a great example of it depends, because let's say you work at a coffee shop and you make your salary and you make tips. If you make income, the question is, how is it taxed? And the answer will be, it depends. It depends on if it'll be tips, and depend on if it's salary. And for a lot of people who work in cash-heavy businesses that have tips, a lot of those tips don't ever actually make it onto the reported income. This will be an interesting change for those kind of people because if they're not taxed, you might as well declare the income. That'll make put you in a better place for getting mortgages and car loans and things like that. Fundamentally, we don't know what's going to be in the bill until they actually pass an actual bill. The fact that Johnson wants to get it done by April suggests that is going to affect 2024 taxes at the very least. And if you have a complicated situation, you might want to wait to file. It's something to consider at the very least until we get some clarity on what kind of legislation they're looking at. Because if it does affect 24, you can always amend, but it's definitely easier just to get everything lined up on the first try. So if you can wait and you can afford to wait, it might make sense to do that. Just keep that in the back of your mind because the IRS is opening for filing next Monday, the 27th. People will start clamoring to get their tax returns in. Some people like to get them done immediately. Some people like to wait as long as possible. And both have their pros and cons. Let's dive into some questions. Serena, what do we have going on this week?
And so we have a AI question. A client wants to know, do you see AI tools changing how people file their taxes and what should we be cautious of?
Yeah, all the big software companies in the tax world are talking about this very question. And how you file your taxes? No. So there's different angles of this question. So one of the things that people are talking about is the IRS implementing AI in their analysis and trying to spot outliers and things like that. Debatable how quickly that will be implemented, how thorough it will be. For filing your own taxes, no, that's not going to happen anytime soon. For helping with your taxes, so the problem with AI is that it doesn't have a low enough error rate to be reliable. So if it's right 80% of the time, that's not good enough when it comes to tax stuff. So it's got to be able to read your information correctly. It's got to be able to interpret your set of facts correctly, and it's got to be able to then combine those into some kind of output correctly. And it's just I use AI a lot in Tax Sherpa, but we do it in document prep and that kind of thing. It's never on the final production level of any kind of tax stuff. But it does help speed up some of the repetitive filing tasks where it's like, oh, we need a document, we need the name of the business at the head of the letter and all that kind of stuff. So we have some tools internally that do that kind of stuff. But even then, sometimes it takes 3 or 4 tries where we got to send the same information so that we get an output that is actually good. For that kind of stuff, AI will certainly be used, but that's not going to be any different than any other company or any other business activity that is in business. or in the business world. So for tech specifically, I don't see it, at least in the near term, I don't see it changing anything dramatically. There are people who are asking ChatGPT or Claude or whatever, they're asking tax questions, and the answers that come back are usually somewhat okay, which
Yeah.
is not a ringing endorsement exactly. But part of the difficulty with stuff is that you have to know what isn't right in order to make sense of the output. So, like when you ask a clarifying question, you have to know what to ask already. So, if you're not a tax expert already, then that's less useful and you might be getting bad advice and then not know it. So it's definitely not ready for any kind of prime time anything. But it is useful if you're already knowledgeable about something, and it doesn't have to be tax, it could be anything, right? If you're already knowledgeable about music or you're already knowledgeable about literature or whatever, then you can start to interact with it. And when it pops up something that's wrong, you can spot that and you can say that, oh, it's actually this. And they go, oh, so sorry. Yes, you're right. So yeah, that's my take at the moment. And I will see if that changes as the technology improves, because it will continue to improve. But for now, that's where we're at with AI.
So don't believe in it 100%. Not just yet.
No,
Okay.
definitely not.
Understood. We have another question
Uh-huh.
about tax myths. So someone wants to know what's a common tax myth that you wish people would stop believing in that everyone thinks is true.
Man, that's a good question. There's a bunch of them. I guess the worst one is that, oh, I don't want to make more because it's going to put me into a higher bracket. That's probably the worst one. We'll just talk federal here. So at federal, there's the 10% bracket, the 12% bracket, 22, 24, 32, 35, 37. And then there may be additional charges depending on other things, like the net investment income tax or the additional Medicare tax, things like that. So if I'm in the 22% bracket and I make more and I get pushed into the 24% bracket, does that mean I paid more taxes than I was before? Yes, but only on the additional income. So I'm still paying 10% on the first chunk. I'm still paying 12% on the second chunk. I'm still paying 22% on the third chunk, and I'm only going to be paying 24% on that fourth chunk of incomes. It's a marginal tax rate, meaning that it's always the next dollar, right? So your as you make more money, your overall average rate does increase. That is true. It's not, oh, I'm gonna end up with less money in my pocket if I make more. That's probably the most pernicious myth, and that's just for people who don't understand how the brackets work, which is a lot of people.
Yeah.
What else? Another one that I've heard is part of the way the tax law works is you're required to report all income from all sources. And that is true no matter where in the world that income comes from. It's true of no matter how big or small. So some people say, I didn't get a 1099, so I don't have to report it. That's not how that works. 1099 is just a piece of paper. You're still required to report stuff. And then if you do stuff correctly or with proper planning, usually it's going to be to your advantage. And especially if you have like business type income. So most small businesses report on what's called a Schedule C, which is a sole proprietorship for tax purposes, meaning that it's just you operating as a business. I talked to a guy yesterday who's in construction and running as a Schedule C. So even if you're an LLC and you file a Schedule C, you're still, for tax purposes, you're still operating as a sole proprietor. And sole proprietorships are the most audited thing. And it's because it has the most people playing the most stupid games. Play stupid games, win stupid prizes. And it's because part of the thing that I want to change in the world is that these small businesses are getting either no advice because they're just doing it all themselves, or they're getting bad advice. And they are reporting it in this way, along with, people who are either reporting things wrong or are just outright making things up, which is both of which are not good. So I guess the myth there is that don't do things in a bad way. So I wish people would understand that it's yes, there's more complexity and more cost to doing things in a better way, but it comes out ahead when you factor in like the full picture. Just do things better.
Right. Tax planning.
Yeah,
Plan ahead. Be
plan
proactive.
ahead.
Yes. So, I have another question about someone wanting to sell their home. They want to know what are some common mistakes people make when selling a home too soon? How can they avoid them?
They're talking about the personal home.
Yes.
Okay. So with the personal home, there is the personal use exclusion. If you live in a property for 2 out of the last 5 years, then you get a gains exclusion, and it's going to be based on your filing status. So if you're single, it's 250 grand of gains you get excluded. If you're married joint, $500,000. So let's say you move into a place, it could be more than 2 years, but it just has to be at least 2 years. And if it's less than that, it gets prorated down. So let's say you move into a place, and here's a big mistake people make. They don't factor in the total cost basis. You buy the house for, let's say, 400,000. Yep, you forgot about your closing costs, which added another 15,000. So now you're at 415. And then you forgot, oh, I remodeled the bathroom and I did this and I did that and I spent another $100,000 on upgrades. So now you're at 515. And that's the number that you have to look at for your cost basis, not the 400 you started with, because you've put all this extra money into it. That's going to increase your cost basis for your personal residence. Then you turn around and you sell the house, however many years later, and now instead of a $400,000 house, it's a $800,000 house. And so let's say you're a single person, and so now the gain is going to be from, if you do it wrong, it's going to be from 400 to 800, which is 400 grand, less the 250 exclusion. That still leaves you with $150,000 worth of capital gains. But if you go from 515 instead of the 400, now you've taken 115 out of that 150 out. You're left with what, $35,000 worth of gains? Much more manageable. You got to pay attention to what it is you're doing when you're using the personal home. I've seen that a few times over the years. And the other thing that I see people mess up on is inherited property, actually. If your parent passes away, leaves you the house, and then you move into that and you're there for a few years and then you sell it, your cost basis is going to be the value of the real estate on the day you inherited. So it's not what you paid, which is zero, and it's not whatever your your parent paid, which could be whatever in the past. So it's going to be market value on that day. That's the key thing to remember in that scenario. Because I see it not all the time, but it's common enough that adult child inherits the property, says, "Hey, I got a free property now. I'll just live there." And turns that into a personal residence. That is a mistake to be aware of on that one. What else do we have, Serena?
So we have a question about the ITINs. Someone wants to know if a dependent doesn't have a social security number but works for the family business, can they use an ITIN for tax purposes?
Yeah, so they have to have clearance on the ITIN in order to work. So that's the thing there. ITINs are individual taxpayer identification number. They always start with a nine. So it's like a social, but it's a special category for immigrants. And the some of them on the card, because they'll get a social security card, and some of them will say specifically not valid for work authorization or work purposes or something like that, where they're specifically excluded from working. And there's different kinds of visas will trigger that kind of thing. So you just have to be aware of that. So if they can work, then it's fine. We ran into a scenario with that over the past year where payroll software would not accept an ITIN because they said it was an invalid social, which it is an invalid social, but it's not an invalid number. So it's a little bit of heartache on our part that we had to deal with, but it can work as long as they're eligible. But if they're not, I think like the student visas, they prohibit work, and a couple other ones, tourist visas, that kind of thing. Yeah, so that's the thing with ITINs. Oh, the other thing is that there was a big hullabaloo about ITINs probably 10 years ago now. The guy who was running that department at the IRS, I think he got arrested for selling numbers to people. Anyway, whatever the reasoning was, they implemented a change where a lot of ITINs now expire after 5 years, where they used to be permanent. So if you have one of those, and there's like a rolling 5 year expiration, depending on the middle two numbers of the ITIN. So if that applies to you, it's not all of them, but it's some of them. If that applies, then you got to make sure to renew your ITIN when applicable to keep that number valid.
Right. So if they're valid to work, then what are the tax benefits of hiring the children in the family business? And
Well,
are there
all
any kind of
the
age
all the other
restrictions?
benefits, yeah, it's going to be the same benefits as hiring any other set of kids to work.
Okay. Are there any age restrictions, Neil, that clients need to keep in mind when they're hiring their children?
If you want the full benefits, that's going to be ages 8 to 17. You can hire anybody at any age, but if you want the max benefit, those are the age ranges that are critical. There's a special setup you have to do for it, but if you set it up right, then the wages are exempt from Medicare tax, they're exempt from Social Security tax, they're exempt from unemployment tax, and if you're paying less than the standard deduction, then they're going to be exempt from income tax as well. So it could be a completely tax-free way to get the kids working. And then you can get the kids once they have earned income, then they can contribute to IRAs. And then if they contribute to IRAs starting in 2027, there's going to be a new tax credit, assuming things remain as they are anyway, where for low income people who contribute to retirement plans, the government will kick in up to $1,000 extra to the retirement plan. That law remains on schedule. That will be an extra benefit for having your kids on payroll and contributing to retirement plans.
But you have to do it right. You have to set up, make sure those family managements are set up correctly for all of
Yes.
the tax
Yes.
benefits to kick in. Okay.
You definitely got to do it right.
Okay.
I've seen people try it on their own and not do it right, and then they've costed themselves a whole bunch of money.
All right. Understood. So we have another question. So someone wants to know, how do couples or families handle taxes when they live or work in different states?
Oh yeah, it's a pain.
Yeah, I was gonna say
So
that too.
it depends on the states, fundamentally. So some states will allow for split status, where let's just say husband and wife. Let's say husband is a resident of state A, wife is a resident of state B. That was actually the case for myself for a while. I was working in Florida. My wife was here at home in Georgia and had that split status. But Florida didn't have an income tax, so it worked out. But yes, sometimes you'll have to do that, register as either resident or non-resident, and depending on a couple factors, depending on how much income is being made in each place and where your home residence is, if you have a family home. Sometimes though, sometimes the couple will have two houses, one in state A, one in state B, and then it gets murkier. Should we file separate? All this kind of stuff. So yeah, it just gets tricky. It depends heavily on the states involved and which ones are allowing for that kind of split status, and if one state has income tax and the state doesn't, and all these kinds of things. But yeah, it's a hassle either way.
It's a hassle just like moving.
Yeah.
So another question I have for you, Neil, is what's the biggest tax refund you've seen someone get and how did they react to it?
The biggest single swing that I've gotten for somebody is from owing $180,000 to getting a refund of about $150,000. And so it was like a 300 and change swing from owing to refund. And he was pretty excited.
I bet.
That was good. That was a good day. He wasn't jumping up and down or anything, which maybe he should have been, but the amount is not really the thing. Because what I have found over the years is that the anxiety and the weight on the shoulders and all this kind of stuff, that is independent of how much it is. Because what matters, the numbers that matter for you is going to be different than what matters for another person. So like the guy I saved 300 grand, he was happy. He was like, "Oh, you're fantastic," and all this kind of stuff. But he was still doing well. In order to have those kind of numbers involved, he's got to be making a whole bunch of money. And the and so it wasn't as emotionally impactful. On the other side of the spectrum, I had a guy, he used to work for those rapid passport places, and he came into the office the first year we worked with him, and he had been owing and owing every year. And we looked at his stuff and said, he did this wrong, he did that wrong, he did the other thing wrong. When we fixed everything, it's, oh, you're actually getting a refund of $2,000 or whatever it was. I don't remember the exact number. It wasn't a lot. And he just sat there and just silently started crying because it was just relief because the amount that he'd been paying really, really stressful for him. And it wasn't $180,000, but it was more than zero. And that had just caused him anxiety. And he knew that when he went into the tax guy's office, he was going to be in for some amount of pain. And then when we were able to flip that around, then all of that just released like a cathartic sort of moment. It's not about the dollar amount. Although the more money you get back, say it this way, the less money you pay, the better. I'd actually prefer people not get refunds because that means they gave the government an interest-free loan. I don't want you to give them the money in the first place. I want you to keep the money in your pocket so that you can use it however you see fit. And then you just pay less or pay zero. That's the better way to go from my perspective. So yeah, it's the emotional reaction does not depend on the number involved. Let's put it that way.
Right. Understood, understood. So we have a state and local tax question.
Yep.
Someone wants to know, how do state taxes differ from federal taxes and do I need to file both?
If you live in a state with state income tax, then yeah, you got to file both. How they differ, there's 50 different states, and 42 of them, I think, have income tax. There's 42 different answers. Some states, they'll take your federal 1040 you'll have wages, and then you'll have interest and dividends and the different types of income. And then at the bottom of page one, you'll have adjusted gross income. Some states will take that number just as is, and then they'll apply their own rates based on that. So like Georgia does that. Other states will do their own calculation as far as what counts for income. So Pennsylvania is a good case where if you have a loss in real estate or a company or something like that, Pennsylvania does not care. They're what's called a gross tax state. Them in New Jersey and a couple others. And so they will do their own calculation to come up with what of your income counts for tax purposes, and then they'll apply their rates based on that. It's a case by case basis, like everything. Obviously, the best scenario is if you live in Florida or Tennessee or Texas or Alaska or Washington or New Hampshire, and you just don't have any state income taxes. That's definitely easiest. But yeah, you got to file both if you live in a state with state income tax. And even if you don't live in a state with state income tax, but you get income from a state with income tax, you still might have to file there, depending on the situation. So like New York and California are particularly aggressive in that way about the source income. We have a lot of clients that are invested in real estate, and the if the real estate's generating a loss, doesn't really matter. It's debatable whether it's worth filing or not because there's no net income at that point. You probably should anyway, but some people skip it. So that's the only case where you might get away with not filing it, is if you have zero or negative income from a particular state.
So this is a real it depends question.
Yeah, that's 50 times it depends.
Right, right. Understood. We have a deduction question. Someone wants to know, how can I take advantage of the Section 179 deduction for equipment purchases?
Yeah. So I was talking earlier about the bonus depreciation. So bonus depreciation and Section 179 are somewhat similar. So 179 is the ability to deduct capital equipment, but there's more limitations on 179 than there are on bonus. So let's just say you buy, I don't know, like a snowplow or something, because it's snowed here today. So let's just say it's a $10,000 machine. The Under bonus depreciation, you would apply whatever the percentage bonus is to that equipment type. So let's say it's 60% bonus. So if you get a $10,000 machine at 60% bonus, it's a $6,000 deduction, just that's it, right? And the remaining 4,000 is going to roll forward and be depreciated over whatever the lifetime of that piece of equipment is. Under 179, you could deduct maybe 10,000, but it depends on a couple things. So one is that it's got to be 179 eligible property. A second thing is that there's a global limit for 179 deductions, which is like 2 million bucks. So most people don't have to worry about that. That's for like big companies. But the thing that catches people off guard is that 179 is only applicable up to the amount of profits that you have. So if you had $15,000 worth of net profit before factoring in this $10,000 piece of equipment, then you could 179 the full 10,000 and you're left with 5 net profit after that deduction and you're good to go, which would be better than a 60% bonus in that situation. However, if you had a net loss already before the deduction for the equipment, then you can't 179 that at all. So it's just 179. And in that case, it's better to do bonus. In some cases where you're in between, let's say you had $7,000 worth of net profit, you could take 179 on the 7,000, and then you could take bonus on the remaining 3,000. And so then you would get the $7,000 179 deduction would get you to zero. And then 60% of the 3,000 remaining would be 1,800 bucks, would get you to an $1,800 net loss. So in that case, that actually works out the best of all the scenarios. If we go back to a scenario, or if we go back to an environment where we get 100% bonus depreciation, 100% bonus depreciation is always better than 179 because it doesn't have those limits applied to it. But if bonus goes away, and bonus is one of these things that has come in and out of tax law over the years. So sometimes there's no bonus, sometimes there's 50% bonus. We've had this 100% over the last several years, which has been fantastic. It just depends on which method ends up being more advantageous depending on the particular numbers and circumstances of your situation. That's the basic idea. It's got to be eligible property, and you have to have the net profit to absorb it. And those are the two primary things that trip people up when it comes to 179. I saw a Grant Cardone clip of on YouTube of him saying he was talking about, oh, you should buy a G-Wagon.
I remember that.
It's a $150,000 write-off. It's over 6,000 pounds and blah blah blah. And it's like, yeah, maybe you have to have $150,000 worth of income to have that make sense. And all these other caveats that go along with it. It's a very much it depends. It depends on the numbers, depends on the circumstances, and depends on the not just the numbers of the item itself, but what else is going on in your business as to whether 179 makes sense or not. But again, if we go back to 100% bonus like we have been, then that's always going to work out better as good or better because there's no net profit limitation.
So is this kind of like kind of sort of it depends question?
Yeah, it depends. Absolutely.
Understood, understood. So I do have a payroll question.
Yeah.
So someone wants to know what are my obligations for providing Form W-2 or Form 1099 to my workers?
Yeah, you gotta provide it.
Yeah, that's true. They do fine you if you don't.
Yeah, they're due to be submitted to the IRS and due to be at least put in the mail by January 31st. You got to get those out. Yeah, that one doesn't depend. That's the thing. So you have to make let's say somebody worked for you and then disappeared. You have to at least make a reasonable effort to send it to a last known address or what have you, whatever information you have, so that people aren't by W-2s and things like that. You got me on a it does not depend question. So that one's a simple answer.
That's true. Ah, so funny. So we have another question, a business structure question. So client wants to know, how do I handle taxes if I run my business from multiple states or countries?
Countries is a whole different thing. Let's talk
Yeah, I
about
was gonna
multiple
say that.
states first. Wherever you're doing business, you have to be registered. So if you're doing business in 3 states, you got to be registered in 3 states. And then you apportion the business activity. And there's a couple different methods, but the most common one is the 3 Ps: profit, property, and payroll. So you weight your activity by those factors, by how much money is generated in each state, how much property, so equipment, warehouses, that kind of thing are in each state, the value of those things, and how much payroll as far as the if you have employees in different places. And you'll come up with a weighted factor for each state of how much of the net profit federally gets applied to each location. And then you're going to pay whatever local tax rates are based on that. So for countries is that is maybe the ultimate it depends question. A company is a legal entity, and that means it exists within a particular legal jurisdiction with a particular legal framework. Even though you could say, oh, we have a foreign subsidiaries, maybe. It depends on who owns what. It depends on the particular structures in those foreign locations. It depends on the flow of control and the flow of funds. So it's impossible to say how that all is going to work because there's just too many variables. That's why you need professional advice in each location because we have clients who are foreign who have US entities. We only do the US side. And we can say, okay, here's what's true here. No idea how this applies to you over there because I'm not an expert in Brazilian tax law or whatever. We can do all the correct flows as far as things here, as far as things are in the US. So in the US, because the US, let's just take it back to the individual level for a second. Sometimes people get jobs in foreign countries. And the US, you are required to pay US taxes on worldwide income. And that is not commonly true throughout the rest of the world. So most other countries only tax income in that country. So if you go to the UK and you have a job there, then you're only going to get taxed on UK income in the UK. But in America, you're going to get taxed on US income and you're also going to get taxed on the UK income. So to somewhat deal with that, there is this thing called the foreign tax credit. And what that does is it calculates is okay, let's say you had $100,000 worth of income from UK sources and you paid $40,000 worth of taxes in the UK on that 100,000. And the US government will say, okay, we recognize that you already paid taxes somewhere based on that income. How much credit we're going to give you for that is going to depend on how much total income you have and the character of it and all this kind of stuff. If you are on the lower side of the income, you'll get full credit. As you make more, they give you less and less credit. for those taxes that you already paid. So that's always fun. Now, in the corporate world, things get more and more complicated with controlled foreign corporations, GILTI income, GILTI, global intangible low tax income, subpart F, and it's just the universe explodes with all the different things that could happen. Yeah, you're going to get taxed on your foreign income one way or another. If you didn't pay it there, you're going to pay it here. If you paid it there, you still might pay some more here. And it just depends on the numbers and the structure involved. That's
It
that.
depends, guys.
It depends. I could talk about that for 2 hours, just that one topic. We'll call the simplified explanation there.
Understood. We have another tax planning question. Someone wants to know, how can I reduce taxes by splitting income with my spouse or kids through the business?
Spouse is usually not going to be effective because you're assuming you're filing jointly because you're still together. Kids can be helpful, and you put kids on the payroll, and like we talked about earlier, with them being exempt from Social Security tax and payroll tax, or Social Security, Medicare, unemployment, and income tax. That can be useful. But yeah, there are some situations where you might not be quite together with the spouse, and that can be useful, especially if there's children involved and there's tax credits for kids. So that can be a little bit of finagling, but that's really depends on the situation. I would say 90% of the time, paying your spouse is not going to be any different than paying you. In fact, it can be worse because, especially if you have a high W-2 that we're talking about here, the key element is the Social Security cap. So this year, I think it's 169,000 is the cap. That might be last year's number. I'd have to check. But once you hit that cap, you'll continue to pay Medicare tax, but your Social Security stops. We've had cases in the past where the husband and wife own a company, they paid themselves equally, and they didn't do the same things though. They decided just to pay themselves equally, and they both paid themselves like grand or whatever the number was. So the total was 300, but they paid Social Security on the full 300 because they did not take into account the fact that they were about to hit the cap one way or the other, and they could have sculpted their income a little bit better in order to pay less Social Security tax. So those kind of things can happen where you should alter the ratios of things. But paying a spouse where there wasn't pay before usually is not going to work out.
So don't go that route, right? The
Usually.
spouse route. Okay.
10%
Understood.
of the time that can work.
Understood. Understood. We have a recording keeping and reporting question, Neil.
Okay.
Someone wants to know, how do I report income from different sources like product sales and consulting services?
Okay. So for tax purposes, it's all the same. Doesn't make any difference. It's just gross revenue. For bookkeeping purposes and business operations purposes, yeah, you do want to keep those separate. So about your internal bookkeeping and reporting system is that you want to be able to look at your reports and then look at that and be able to gain information and make better decisions going forward. That's the entire purpose of the reports, which people are underappreciate, I think. So so if we have a service item and a product item, then you want to be able to look at those and say, okay, which one do I want to emphasize in my business? Which one is bringing in the most now? Which ones do I want to pay more attention to? Which one do I want to pay less attention to? So let's say you have a car repair shop. And okay, so you charge for labor and you charge for parts. And the parts, let's say you're doing cost plus 15 or something like that. And the labor you're just charging an hourly rate. And you get to look at that and you say, okay, let's say I have $10,000 in parts income, I have $10,000 in labor income, but I know that parts income is only 1,500 bucks worth of real revenue after cost of goods. So where do I want to spend my time? Where do I want to emphasize? Looking at those things, if I have the capacity, it makes more sense to focus or double down on the service side of things because that has much higher margin than the so as far as like how you do that, it depends on what bookkeeping system you use. For our clients, we typically use QuickBooks Online for everything. And then the you want to have it broken down to the point where you can make actionable decisions. And if it's just numbers on a page, then who cares? Just on one, and it's just revenue. But if you're looking at your books and you are doing the analysis as an owner and manager, then you have to separate it to the degree where it makes sense to you. In fact, I was having a discussion with a client about this earlier, where she's using Stripe as a payment channel. So Stripe collects all these sales, and they're low ticket sales. So they're like $7, $2, $5, whatever. And then she gets a single deposit at the each day based on what came in the previous day. And so we were talking about, like, do you, in your reporting, do you want to see each individual sale for $7? Does that matter to you? Or do you just want to see the total that hits your bank account? And in her case, it was too much to look at each thing individually, so she'd rather do the batch number and just take the total for the day. And that's fine. And so it just depends on what you're trying to get out of your reporting system and what you want to do with it. Those decisions based on your particular business.
So really, it depends.
It depends. Yeah.
Okay, so I have another question about how long should someone keep their receipts and invoices and other business records for tax purposes? Is there a
Okay.
limit?
But there is a limit. So here's the thing. You will hear different answers to this question. You'll hear commonly two different numbers. You'll hear either 7 years or 3 years. Realistically, those are okay. What happens is there's a statute of limitations for, and this is just federally. There's a statute of limitations on tax issues, which is 10 years. So if you want to be thorough, you would keep everything for at least 10 years. And then after 10 years, you can start getting rid of stuff. So as tax preparers, we are required to keep records for 10 years because of this statute of limitations issue. Now, the the 7 year thing comes from IRS policy that they're not going to go back more than 7 years. So that's where that number came from. It's not based on anything really firm, but it's just like what the IRS typically does. It's a wishy-washy number. And then in practice, what happens is the IRS will typically have an audit cycle of about 3 years. Like right now, we're starting to file 2024 tax returns. If something is 2020 and earlier and it hasn't been brought up yet, you're probably past the window at which point they're going to look at it. They still could if they chose to, but it's just not typically what they do. So if you want to be bulletproof, 10 years. If you want to be mostly safe, 7 years. If you want to be a little bit more aggressive, then 3 or 4 years. So that's federally. Most states will follow that. California, however, has no statute of limitations at all on tax issues. So we had one woman, she comes in, this was like in 2014 or something. She comes in and she brings this letter. It's from and this is, we're in Florida. She brings in this letter. It's from the Franchise Tax Board of California. And they say you owe us $1,000 from 1978. And so I talked to her. I was like, "Did you live in California in 1978?" She did. And it didn't say what it was for. It just said, "You owe us money." So this was 30 or 40 years later, whatever it was. And California says, "Hey, pay it." So there's that to factor in. As far as I know, and I have not looked at every state, but as far as the ones I've run into, I think California is the only one that has that particular issue. So there's that. Incidentally, in that scenario, what we ended up writing a letter back to California saying, "For what are you claiming this based on?" And then we never heard back from them. I guess they dropped it. Who knows what it was? And it's a great example of how 70% of notices don't get responses, but the ones that do, they know they aren't going to roll over. But as far as how you keep those records, if you're paying online for something, then typically you get an email receipt. Those are real easy to keep, right? It's when you're in person that you have this receipt issue. If you get a piece of paper as a receipt, then if you want to be real good about it, take a picture of the piece of paper. Because in 3, 4, 7 years, whatever, that piece of paper is going to be illegible. It's either going to fade, the paper gets all crinkly, or whatever. So take a picture of that receipt, and then you have an archive of that will last. And then if you paid cash, then obviously that's all there is. But if there's a credit card expense that is going to match up with that particular receipt, then that's ideal. Now there is this thing called the Cohen rule, where they say that anything under $75 does not actually require a receipt. I will tell you that in practice, I have seen by people IRS agents, some of them will follow that and they won't care about the small stuff, and some of them are just giant pains in the ass and don't care if it's 3 cents, they want to see a receipt. Otherwise, they're going to disallow it. So you have to measure your paranoia level. Ideally, you don't get audited in the first place, but if you do, it really depends on what personality you get on the other side. Yeah, so there's that. But yeah, if you want to be fully maxed out safe in terms of receipts, keep everything for at least 10 years. Take pictures of anything that's in on paper, and anything digital, obviously keep those files as well. I didn't realize we were at the end of the hour already. We'll call the questions there. And I will tell you in these last couple of minutes what you want to do for next steps. If you want to get the starter course, become an explorer. Go to taxsherpa.com/explorer. That is our free group where you get access to these calls. You can submit questions if you want. and you get access to a lot of our, not all of them, but a lot of our tools and courses and things. So my favorite two that are available to the explorers for free is our quick and dirty bookkeeping and our partnership success guide or partnership success blueprint. So the quick and dirty bookkeeping is when you don't have QuickBooks or whatever, you're just operating out of your bank account, you still need records, right? So you can upload documents to the AI and it'll auto summarize the statement for you and it'll come up with a ledger, which then you can put into a P&L kind of thing. It's pretty fantastic, actually. It's I build these things for myself and then I just let other people use them. This is what I use internally when somebody sends me 12 bank statements rather than P&L. It only works for simple situations. So like cash basis, it's not going to book assets or liabilities or anything like that. It's just going to say money in, money out, and it's going to auto categorize all that stuff. The other one that I love is the Partnership Success Blueprint. These are 13 questions that I have seen play out in real life, either my own life or our lives of clients, of ways partnerships go wrong. And what you want to do is before you go into partnership, you want to have these discussions and figure out, okay, if this were to happen, how would we handle this? And write that down and put that into your operating agreement. And then you have a plan because by the time something happens, it's already too late. For example, I'm trying to think not morbidly because death is one of them. But let's say your partner becomes a drug addict and you didn't know this when you started business. If you did know this when you started, then just don't go into business with that person. But trust me on that one. But if somebody develops a drug habit while you're in business, you want to have a mechanism to buy that person out or have them buy you out so that you don't have to continue to be in this horrible situation. But if the person's a drug addict at this point, they typically are not real useful for negotiating. So you want to have the formula and everything set up beforehand so that you don't have to have a negotiation conversation with a drug addict. Stuff like that. And there's 13 of those issues to go through and figure out what it is you want to do and create a proactive plan so that if and when some of these things happen, because all partnerships are going to end, right? You're either going to either the business is going to fail in some way, or even if it succeeds, you guys are not going to work forever. All partnerships are going to end. So you want to have an exit plan, and there's multiple off ramps to how these businesses end. So have a plan, and then when the time comes, you will be able to implement your plan and the heartache and loss of money, really, that comes along with that. It's one of my favorites. It's a guide I wrote. But yeah, you can get all that at taxsherpa.com/explorer. And then you'll also, as an explorer, you'll opt into our emails and I'll let you know about things like the beneficial ownership information report, all the saga that's been going on with that. Right now, just so everybody knows, not currently reportable although the court case has been back and forth just like crazy. I sent out an email last week saying, hey, IRS is opening on the 27th and things like that. So if you want to stay up to date about business and tax and all that kind of stuff, definitely check out the Explorers. And with that, that'll wrap it up for this week. We'll do it all again on the 28th, 6 p.m. Eastern. We will see you then.
Alrighty, see you there.